There were people that said the S&P wasn't even going to make $60 again for a decade. That's why in the GFC, everyone said expect a decade of low returns. And I saw countless models. People said, well, inflation's going to be weak and GDP, and so it'll take forever to get to $60 in earnings again. Well, the S&P 3 years later had $90 in earnings. And, and now earnings are expected to be $280. Okay. So we've gone from $60 to $280 in 14 years. Why do people suddenly think earnings are going to peak at 280?
Of course, that sounds extremely bullish. S&P 500, 15,000 by 2030. How do you get there? Compounded rate of 15% earnings, that is, plus a 5% expansion. It also talks about the Russell 2000 to reach 3,000 this year. Of course, you will see a bigger jump after rate cuts. He says it's small caps time to shine. And to be honest, he's not the only one thinking this way, because a couple of weeks back on the Brad Gerstner and Bill Gurley podcast, they talked about tech exposure. And you can clearly see here on the screen that tech exposure has come down quite a lot. You might ask, why is that? Are people now suddenly bearish big tech? No, it's purely because big tech, the big companies, S&P 500, has had quite a good ride, has gone up already quite a lot, whereas tons of other companies on the market, Russell 2000 for example, the companies there, did not get the same treatment despite better PEs, despite bottoming of EPS and more growth ahead. That's not to say that they're not holding big tech anymore. That's not to say that big tech won't perform extremely well in the future, because remember, tech still an important part and tech will still continue to grow for years and years, or at least that's the expectation. Now, as Tom Lee has explained, expectations can change, estimates can change. He talked about the great financial crisis, how pessimistic people were. The reality was, well, things got much better, much quicker. As we've discussed in countless videos, usually the stock market recovers way faster than the economy if we are entering a recession. He doesn't think we are entering a great recession or just a recession as a whole. He does think that a lot of it is priced in right now. And so if a recession does not happen, imagine what will happen with all of these stocks. Imagine what will happen with all of these companies. Because remember, eventually, in the end, it's the business that decides what the stock will do in the long run. It's the business that grows earnings, not the stock. The stock is what you buy because you've studied the business, because you've seen that earnings are increasing, you've seen revenues increasing, you've seen margin increasing as well. That's the point. Now, we're not done here, because I'm making actually this video because a subscriber commented on a video a couple of weeks ago talking about, is it still worth it? Is it still worth buying big tech companies? They're already so big. I'll already answer part of this question right now. I think yes, because these types of companies, especially in this day and age, AI, high-tech, cloud, all of that, in my opinion, when you're that powerful, it's going to be extremely difficult to take over their place, their dominant place. Because, as you've seen right now, the big tech companies are one of the only ones, if not the only ones, that can spend billions and billions of dollars on AI infrastructure. All the others don't have the same amount of money to spend on data centers, on GPU and stuff like that, like the Amazons, the Google, the Microsoft, the Apples, the Tesla, the Nvidias. Well, the Nvidia is the main beneficiary of this, or one of the biggest beneficiary of all of this. You do not see the smaller startups spend that much money. No, the smaller startups will use cloud services, will use Nvidia, not on the biggest scale, but that's what they can do. And so yes, in the future, I do expect big tech companies to continue to grow. And remember, 10, 15 years ago, when these companies were at $100 billion, $90 billion, $200 billion, people were also saying, is it worth buying these companies right now? How much more, how much bigger can they grow? Well, they grew bigger and bigger. 100 billion became 200, 200 became 400, suddenly 400 became 800 billion. And then you're like, oh, is this going to be the first $1 trillion company? Guess what? Yes, $1 trillion company, then 2, then suddenly you go from $1 to $2 trillion, even faster than before, and so on and so forth. So just because we haven't seen those things happen before does not mean that it will not happen in the future. If these companies can generate more and more profits in the future, if these companies can become bigger and bigger, generate more revenue, actually go into extra markets, then why shouldn't they become bigger? Just makes sense, right? Plus, they can buy back more shares. They can eventually, and probably every big tech company will eventually pay out a dividend. So that's another way to get your money back. So yeah, I do think that 10 years from now, 15 years from now, going with just big tech companies, I think you're going to do quite well. Of course, there will still be winners, even smaller ones. But the company has to be a pretty good one. Just because you're a small company does not mean that suddenly the returns can be 10x. Like I've said in the previous video, you can find that in the top right corner, not everything does a 10x. Very important to note. Although there are some people that will make you think that everything can 100x, that's a lie.
I mean, S&P earnings, is going to be over $1,000 per share in the near future. And I know it sounds incredible, but one of the things driving this, and we've written about it for our clients since 2018, is that the world is running out of prime age workers. By the end of this decade, it's almost $4 trillion a year in wages that are no longer paid to people, but to another company.
And this, of course, is another good point. If the necessary input becomes smaller and smaller, and your output becomes bigger and bigger, I mean, the outcome is quite easy to understand, right? And I do think that moving forward, moving into a world where we're going to have a lot of humanoid robots, we're going to have AI taking away jobs. I mean, it's sad to say, but I do think that that's the way we're going to. Then yes, these companies, plenty of tech companies and non-tech companies, are going to be the main beneficiary of that. They're going to become bigger and more profitable. Now, to the points that he mentioned at the start, this is basically what you get right now. S&P 500 change in forward 12-month EPS versus change in price in 10 years. What do you think people were saying back here in 2014 at $130 or so? They were probably saying the same. Oh, it's quite high. How much higher can it go? Well, 2018, 2019, 180 or close to 180. Of course, then we've got the pandemic, so we took a hit there. But again, probably the same thing was mentioned again and again and again. How much higher can we go? Even here at the previous peak, 240, before we dipped a little bit. Same arguments. How much higher? How much higher? Then we dipped. People were probably saying also, oh, it's the end. We're not going to go higher anymore, etc., etc. And now we've made our way back to over 260. And yes, I do agree with Tom. I do think that this will continue to grow and could reach $1,000 in the next decade or so. He also talked about the prime age participation. So prime age job participants are typically individuals between the ages of 25 to 54. This demographic is often considered the backbone of the labor force due to their generally high levels of education, experience, and physical capability. And as you can actually see in the last couple of years, the women part of it has actually increased quite a lot. Now, what happens when you reach the peak of prime age participants? How can you tackle that? Well, there are a couple of points. Increasing labor force participation rates for women and older workers. We're already seeing the women part right now. Enhancing education and training to equip younger workers with necessary skills. Well, then you need a better educational system. That's going to take a while. Promoting immigration to supplement the domestic workforce. Of course, legal immigration, people that come into your country, study, should get an easier way to get a working visa. That's how you retain good talent. Last one here, encouraging automation and technological advancements to boost productivity. And this, of course, we will definitely see with AI, with humanoid robots. Now, before jumping into the portfolio part of this video, since this is the portfolio series, I'll go even further to show you that, well, things are usually getting a bit better right now. Because if we look at the S&P 500 net profit margins, the expectations, and not just for Q2, but for the rest of 2024, is that we're now going to be at net profit margins back above 12%. And we're going to stay above 12%, which is going to be the first time since somewhere in 2022. So yes, we did peak at 13% here in Q2 of 2021. Then of course, the stock market also retraced quite a lot. We were quite high. Things weren't going well anymore. And so we did a little retracement. Well, little, some stocks were down 50, 60% or so. But right now, for people that are thinking, oh, some companies, EPS is down, maybe it's not worth buying. Well, usually you buy when EPS is low or close to bottoming. Again, we don't know when things will bottom, so you buy it as low as possible, or you try it at least, and then you sell it when it's as high as possible. If right now we are going to continue this trend here where net profit margin is increasing each and every quarter, I mean, I would love to be a buyer now and not a seller. Continuing here, if we look at the S&P 500 earnings, above, in line, or below estimates, most of these industries here, utilities, healthcare, materials, S&P 500, financials, industrials, info technology, consumer table, etc., most of them are above. And this is earnings. Why is it important? Well, because we've talked about this before. Lots of companies are expected to grow and are growing their earnings, their EPS, faster than revenue. As you can clearly see right here, way more are coming below, and that's in each and every sector. And the last one here, before we jump into the portfolio, is the S&P 500 trailing 12 months PE in the last 10 years. So the 5-year average sits here at around, close to 24. If you look at the last 10 years, it sits closer to 22. Now, you might say, oh, okay, that means that right now we are in expensive territory. No, I don't think so, because again, I think that companies can earn more money with less. Now, of course, this period right here and even before, this is a period that it's once in a lifetime type of thing. But to say that right now, automatically, oh, things are extremely expensive because we're higher than the 5-year average and the 10-year average, and even if you delete these things here, we are in expensive territory. No, just like I've said, I think 2 months ago or so in one of the portfolio videos, 20 years ago, 10 years ago, to make a certain amount of money, you had to spend a certain amount of money. These days, the reason why you are going to pay a little bit more, the reason why there is a small premium right now, which the premium will become the norm in the future, is because you can generate more profits with less. More free cash flow, let's say future free cash flows, look also a bit more secure, not for all companies, but for some companies. Less input, more output. There is also a reason why a company like Coca-Cola, for example, has, let's say, a high premium compared to another tech stock, for example. That's because Coca-Cola's future free cash flows are way more predictable and maybe even secure than a tech company. Because a tech company, because of AI, even if previously it was a dominant tech company, because now the rise of AI, generative AI, artificial intelligence, robotics, you name it, whatever is coming out these days, maybe that will disrupt this type of companies. And suddenly, future free cash flows are not that secure anymore. And then you're going to see, yes, their previous premium come down quite a lot. Whereas Coca-Cola, a company that, in my opinion, will still be here for a long, long time, I don't think anybody will successfully replicate what they've done. No, their free cash flows are very, very predictable, and the company will grow in line with the market, maybe sometimes slower, maybe sometimes faster. It pays a dividend, great company to hold for the long term, and that's why you're going to pay, let's say, a higher premium. So, with all of that out of the way, let's have a quick look at how the portfolio has been performing. And so, after a couple of weeks of outperformance, right now the Couch Investing portfolio, well, at least last week, took a big hit. We're down 3.7%, whereas the S&P 500 is only down 0.83%. Since we started this challenge, well, I'm basically flat, and the S&P 500 is up 9.6%. Now, mind you, a couple of weeks ago, actually 10 days ago, the portfolio was up close to 9% compared to the S&P 500 up 13.71% since the start of this challenge. But of course, like I said in that video, it happened because some of the big positions, let's say, or the bigger than other positions were performing quite well. Now, of course, when Tesla takes a hit, when it's down 10% or more in a week, when Google is down 10, 12% in a week, yes, my portfolio will of course take a bigger hit. But when these stocks, when my top 4, my top 5 actually does perform and does go up faster than the overall market, then you're going to see this acceleration in this outperformance. Now, in the short term, I can sometimes beat, I can sometimes underperform. In the longer term, I fully believe that the positions that I have here, and some of them might change in the future, I believe I will outperform. Now, I did change a couple of things. I did sell out completely of Adobe, not because I am bearish on this company, not at all. I sold for a 3.79% gain, purchased another 10 shares in Alphabet at $164 because it went down after a good report, which we covered top right corner of the video. I also purchased another 35 shares of PayPal at $57.75. Why is that? I think it's extremely undervalued. Next week, Tuesday, earnings report, we will cover that on the channel. And I purchased another 3 shares of Meta. Also, their earnings is coming up. If it goes down more, then I'll just buy more because I do still think that they are in an extremely dominant position. Still have 4.63% cash here. Lululemon, I did a video about them on, well, a couple of hours ago, actually. I did add 4 extra shares at $250. Why is that? Well, I do think that valuation-wise, it is now quite low. The pessimism level is quite high, despite the brand still being loved by a lot, if not most, of its customers. So that's, let's say, the review for this week. Of course, most of these companies are still going to report their quarterly figures, so expect ups and downs, hopefully more ups than downs. And so to conclude, yes, I do think that big tech companies can continue to grow. I do think that it still makes sense to invest in them. And I also think it makes sense to invest in smaller companies as well, but smaller dominant companies, right? For example, Mercado Libre is a smaller company. It's a big one, right? It's what, $80 billion, $90 billion in market cap or something like that. But in my opinion, their potential is to become a $100 billion company, if not more. When will that happen? I don't know, but I do expect them to grow more and more. Of course, I also have companies like AppCellera, which is a long-term bet, can go to 0 or can 10x. This is the type of bets we're making here with the smaller positions. Rocket Lab, same thing, although my conviction levels for Rocket Lab are much higher than a company like AppCellera. But these are the companies with a low market cap and high ceiling. Same with the local, same with SoFi. It can, of course, completely fail and my investment goes to 0. Well, hopefully I'll sell before it goes to 0. But these types of companies still exist. The companies that are not big tech companies or are tech-ish, but not completely in the big tech, let's say, field of vision where they see what they're doing and then they completely ruin their business plan. No, these are types of companies that are still small enough. Business is doing well, sometimes not so, sometimes maybe good, sometimes maybe shit, but they can succeed and they can become, yes, multi-baggers in the future. Of course, that's just my opinion. Do share yours down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.